Okay, so let's get started. Continuing on with, now we're going to create the cash flow statement. So what we did on, if you remember Monday's video, we talked about the three types of, or the three sections of the cash flow statement, right? So one, we had the operating section, for operating activities. Okay, then we had two, our financing activities. Well, let's go investing activities. And then thirdly, we had our finance activities. So what we're going to do is for today and tomorrow, we're going to focus on the operating activity section. Okay. So again, if you go in your textbook on page 1034, there's an example of a cash flow statement, okay, using the indirect method, which is the direct method, which is the method that we're going to focus on. Okay. So what we need to start doing is we need to start preparing this section, okay, of the cash flow statement. So again, today's focus will be on operating activities. Okay. So if we want to start preparing the cash flow statement, well, what are our steps? And this is on page 1036. So we're going to run from page 1036 or 1034 to 1044, okay, and that'll cover slides 17 to 28. Okay, so with the cash flow statement, okay, we have a few steps. Okay, so we need to calculate the net increase or decrease in cash and cash equivalents. Okay, we can get that directly from the balance sheet. And if you look at page 1037, the cash in 2020 was 17,000. The cash in 2019 was 12,000. So we have a net change, a net increase of $5,000. So that's what we're going to have to account for. Okay. Two, we want to calculate and report the net cash flows, the net cash inflows or outflows from operating, investing, and financing activities. Okay. And then three, we're going to reconcile the cash balance. Okay, or recognize that change in the cash balance. So let's start with our operating activity section. Okay. Now again, we're going to cover the indirect method. So the first thing that we're going to do is we're going to start. We're going to have we have our title. Okay, company XYZ, cash flow statement. And year-end, December 31st. Okay. Now, again, we're going to do the indirect method, not the direct method. Okay. Now, for whatever reason, International Financial Reporting Standards encourages the direct method. I've said this before. I don't know why they encourage the direct method, because everyone does the indirect method. Okay, so our focus is going to be on that indirect method. All right. So with the indirect method, it's going to yield the same cash inflow or outflow from operating activities as the direct method. So again, everything's the same. I believe it's just a little bit easier to do, to calculate it, to understand. Okay. Other than that, I'd like to get into the direct method. So this method begins with a profit and loss, okay, and then we make adjustments. Okay. So notice on page 1039, we started with cash flows from operating activities. That's going to be our title. So it's in the textbook they say cash flows from operating activities. Often I just put, when I'm making one of these statements, I just put operating activities. Okay. Then I'm going to have my net income. So that's our starting point. Okay. So again, what we want to do is go directly to the income statement, find out our net income or our net loss, and we'd add it in. I don't know, maybe it's if we're consistent with the textbook, we'll just say it's $38,000. Now, what we then want to do is we want to look at the changes. Again, operating activities is only going to focus on the balance sheet with our current liabilities and our current assets. Okay. So that's why if you look at page 1039, you can see our adjustments to reconcile profit to net cash provided by operating activities. So again, we want to look at the changes in the non-cash current assets and current liabilities. We want to look at the operating activities that do not affect cash in inflows or outflows during the period. Okay, and then we also want to look at gains and losses resulting from investing and finance activities. Okay. So, non-cash current assets. What is that? Well, let's think of our balance sheet. So we've got to go to the balance sheet. AR, inventory, prepaid expenses, okay? Anything that is a current asset but not cash. Okay? So what we're going to do is when we have for operating activities, decrease. Okay? So when we have a current asset that is a decrease in a current asset, we want to add an increase in a current asset, we're going to subtract the difference from the current year to the prior year. Okay, so decreases are added to the profit, increases are subtracted from the profit. So there's a good chart that summarizes all this on page, where is it here? It used to be here. Page 1059. All right, so we're going to look at, again, this is off our balance sheet. Okay, so let's take a look at this example on slide 1622. So it says here, a review of a company's year-end financial statements reveal that accounts receivable was $40,000 in 2019 and $60,000 in 2020. Okay, so we can just make a partial balance sheet. So our AR, 40 and 60. This is how I do it. Okay. So it's a decrease of $20,000. Why did your AR decrease? Well, likely you collected on it. Inventory. Okay. Now, this question is good because it's following the example on page 1039. 70 and 84. Okay, another difference of $14,000, so we're going to subtract. That went down. So we have a decrease in the current asset, a decrease of 20 and a decrease of 14. We're going to add that to our net income. Okay. Profit for 2020 was $38,000. Okay, so we already got that recorded. Okay. So how are we going to report this? Well, we need to do our adjustments. Okay, so we're just going to put in again setting up the operating section. So again, depends on how you want to present your cash flow statement, but again, sometimes I just put adjustments or non-cash adjustments, okay, and depends on who's creating these statements. So that's my starting point. So you can see, how is this going to look like on our cash flow statement? Well, I'm going to take this information here. Okay, I'm going to have decrease in AR. Remember, a decrease, we're going to add it to our net income. So a decrease went from 60 down to 40 minus, so it's an add, we're going to add in 20,000. And then same thing, decrease in inventory. Okay, it decreased 14,000, so we're going to add the decrease. Okay. I just read this wrong. Notice on the textbook, why did I read this wrong? Because these numbers are reversed. Okay. They're actually increases. So 2020 and 2019. Okay. So 2020 was 60,000, 40. And then inventory was 84.7. Okay, sorry about that. So again, a difference of 20,000, a difference of 14,000. So we had an increase in our current asset. So with an increase in our current asset, we want to subtract the differences. Okay, I couldn't read that initially. Increase in AR, so we subtract the increase, and we subtract an increase in inventory. Okay. Now from there, we're going to go look at the rest of our current assets, or sorry, the rest of our current liabilities, because we're out of current assets. Now it also said here, I don't know why in the example they didn't include current, they didn't include the increase in prepaid expenses, but in this example they do. So it looks like here we had an increase of prepaids of $2,000. Okay, so we're going to again subtract the increase. Now, so notice here, this was all current assets. Okay. Again, that ties in to page 1039. Now what we're going to do is we're going to go look on the balance sheet, and we're going to look at our current liability section. So current liabilities is a little bit different. So with current liabilities, what we want to do is increases increase in current liability, we're going to add it, and a decrease in current liability, we're going to subtract it. Okay? So right now then, let's go look at the example, and this is now on slide 24, 1624. So a review of a company's year-end financial statements reveals that accounts payable was $40,000 in 2019, $35,000 in 2020. Okay, so again, we make our little mini balance sheet here. Okay, we have accounts payable 2020 and 2019. So 40,000 in 2019 and 35,000 in 2020. So we had a decrease of $5,000. So what I would do is I would go all along my balance sheet, okay? And because I know I need to make the operating activity section. So I can just go and calculate my differences between the current year and the prior year, which will set up the operating activity section, or the numbers that I need to create my operating activity section. Okay, so now I also know that I had interest payable, 4,000 in 2019, 3,000 in 2020. Okay, so interest payable, again, 4,000 in 2019, 3,000. So again, in 2020, so another decrease of $1,000. Okay. Anything else? Now, also, I don't know why, again, why in the slide 24 they don't say this, but we also had a decrease in income tax payable of, in this case, income tax payable, increase in income tax payable, $10,000. So, I don't know the numbers here, but I can tell from the income statement, okay, we had an increase in the current liability, so the difference must be $10,000. So now, what are we going to do? We're going to create the rest of the operating activity section related to the current liabilities. So I'm just going to move across here. Okay, AP. Okay. We had a decrease in accounts payable, so a decrease of a current liability. Okay, what are we going to do? Well, we're going to add it. Sorry, subtract it. Did I get my numbers all wrong here? I think so. So with a decrease in the current liability, which is what we have, 40, so it's gone from 40 down to 35. So a decrease in a current liability gets added. I don't know why. I have the wrong things in here. Increase gets subtracted. Okay. So again, notice how our accounts payable went down $5,000. Okay, so now current liabilities go in the same direction as what's happened in the prior year. These are wrong. So that's how that looks. So we'll go over this all together once I have everything up on the board. Now we also had a decrease in interest payable. It's so awkward doing this class in this little room here that I have. Okay, and then we had an increase in income tax payable. So what happened there is they likely just didn't pay their $10,000 of income tax. Okay, so we're going to add the increase. So let's stop there. So that's all our adjustments that we're going to make to our operating activity section that relate to the current asset and current liabilities. Obviously, we've gotten that off the balance sheet. Okay, so again, let's just go over this. When we look at the current assets, okay, we had AR in 2020 was 60,000, and in 2019 it was 40,000. So we had an increase in current asset. So what do we do with an increase in a current asset? We subtract it. We subtract the balance from net income. Okay, same thing with inventory. Inventory was 84,000 for 2020, 70,000 in 2019. So an increase of 14,000. What do we do with an increase? Well, we subtract it from that income. Prepaid expenses, we didn't have enough information. We don't know the current balances, but we know the change. So it must have increased last year as a result, over last year as a result of why we're subtracting that $2,000 balance from net income. Okay. Now, moving on to current liabilities, same thing. Okay. 2020, we had a balance of $35,000. In 2019, it was a balance of $40,000, so a difference of 5. So since our current liability decreased, okay, we're going to subtract that difference. Same thing for in interest payable, it decreases, so we're going to subtract that. Again, current liability subtracts. Okay, and now we have an increase in our income tax payable at $10,000. Okay, so with an increase in current liabilities, we add that to net income. So that takes care of all of our current asset and current liability sections on our balance sheet that we have to report to the cash flow statement. What's left? Okay, well, what's left is making adjustments for items that do not provide or use cash on the income statement. Okay, so example, expenses with no cash outflows are added back to profit. Okay. Revenues with no cash inflow are subtracted. So an example there is when you have a gain on the sale of equipment. Okay, so you got to go look on the income statement. If you see gain on sale of equipment, gain on sale of an asset, okay, you subtract that. Why? Because you're recording the cash that you get from that sale in the next section, which is a investing activity. Okay. Again, over time, we're going to get an idea of how this stuff all works. Okay. Again, if we have a loss with no cash inflow, an expense with no cash outflow, we add that back. So maybe we had a loss on sale of equipment, loss on sale of investment, we add the loss back. Okay, and you can see that's what happens on the example here. Okay, so let's take a look here. We have a okay, one more adjustment that we'd also make is depreciation. Right? Why? Because in that net income up here, we have a depreciation expense of $24,000. But that has nothing to do with cash. Okay? Why? Well, think about it. We don't write an amount, debit, paid depreciation expense, cash amount of X amount of dollars. We just don't do it. It's an accounting transaction that's non-cash. So we're going to add back our depreciation expense. $24,000. Again, why? Because it's a non-cash transaction. It didn't use cash. It was recorded on our income statement, again, recorded in the $38,000, but it has nothing to do with cash. This is the cash flow statement. We only care about putting items in here that affect the cash balance, that made that cash balance go up and down. Okay. Now we have two more adjustments that we make. Let's take a look at slide 28. So again, in the profit amount, it may include gains or losses that are not operating activities. So these items are removed from the operating section. So let's assume in that profit of $38,000, it includes a loss of $6,000 on the sale of equipment. Right? So again, what I'm going to do is I'm just going to go up here. Let's take a look at how that would be recorded. Let's just say we had cash. We sold the thing for $20,000. We had a loss on sale of $6,000. We had our accumulated depreciation, let's just say that's $40,000. So as a result, the asset that we sold, or the equipment, had to have been $46,000. Okay? So that loss would have been buried in the $38,000, but it's non-cash. Okay? The cash that we received from the sale of the equipment was $20,000. We're going to recognize that $20,000 in the investing section. Okay? So again, what we're going to do is we're going to add back the loss on the sale of equipment. Okay? Again, these adjustments here are all off the income statement. Okay, lastly, we might have a gain. Okay, and in the textbook it says we do have a gain. We have a gain on the retirement of bonds. So again, someone paid us. We sold the bonds for more than they were worth. We reported a gain, but again, that gain, the cash that we made from the gain, will be reported on the investing section. Okay? So what we need to do is we need to back out the gain. So gain on sale of bond. Again, page 1039, and that'll be 16,000 minus 16,000. We want to back out the gain. Okay? So what we'll do is we'll add up. We'll take the 38,000 minus 20,000 minus 14,000 minus 2,000 minus 5,000 minus 1,000 plus 10,000. Add back the depreciation of 24,000. Add back the loss of 6. Subtract the gain on the sale of bond of 16. What are we left with? We're left with a net cash inflow from operating activities of $20,000. So that is step one in dealing with cash flow statements. Okay? We need to make the operating activity section. Okay? So for the next few days, that's all our focus is going to be, is on the operating activity section. So we're doing really good for time right now, so I want to go slow because I find that this is the most difficult statement. Okay? So again, we have a couple questions, QS 13 or 16.3, 16.5, and 16.6. Okay, it's going to ease us into making these cash flow statements. Okay, and then for Thursday, we're going to continue on exercise 16.3 and exercise 16.6. Again, it all relates to the cash flow statement. So if you have any questions, please let me know. Again, I said before that I believe that this is the most difficult statement to create. Okay, I mean, even my example here, I kind of forgot at you know, as the camera light was on, I kind of forgot what we do with a decrease in a current asset versus an increase in a current asset. Okay, so it's inverse. Okay. So again, we just got to remember our rules on operating activities, and we're going to flow that into our operating activities section and make our adjustments accordingly. Okay. So this is the first number that we need, $20,000. Okay. Now, again, once we get on into creating more cash flow statements, then we're going to create the finance section, then the investing section, or vice versa, the investing section, then the finance section. Now, we're doing this in parts. On the exam, you'll have to do the whole thing, you know, as one correct statement. But I'm going to leave it there for now. So again, for May 6th and May 7th, this is going to be the topics, okay? And this will carry us through to slide 28, which is where we're going to leave off. All right, so that's it for today. If you have any questions, please let me know. There's the odd person that has not yet handed in their quiz. Please do so, or I can't give you any more. All right, have a good day, and we'll talk to you on Friday.